Have you ever driven past two buildings that look pretty much identical and wondered why one might be worth millions, even tens of millions more than the other? Well, it's not always about the location. The real secret, the thing that can make or break a property's value, is who's inside paying the rent. Let's get into it. So, to really wrap our heads around this, let's start with a simple puzzle. Picture two commercial properties sitting right next to each other. All right, so on one hand, you've got Building A. It's a massive 100,000 square foot warehouse, and the entire place is leased out to Amazon. Then you have Building B. It's the exact same size in the exact same prime location, but instead of one huge tenant, it's home to 10 different local businesses. So what's the big deal? I mean, they're both fully occupied, they're both generating rent. And yet, Building A, the one with Amazon, is going to sell for a lot more money. So what gives? Why is that? Well, the answer is a concept that is absolutely fundamental in commercial real estate. It's the one thing that investors and lenders obsess over more than almost anything else. It all comes down to two words: tenant credit, or, tenant credit quality. This is the whole shebang. It's the reason an investor can sleep at night feeling confident that those rent checks are going to keep rolling in month after month.
Okay, so what does that actually mean in plain English? Well, think of it like this. It's basically a report card on a tenant's financial health. It measures how likely they are to actually pay their rent on time for the entire length of their lease. It's all about assessing the risk that they might one day just stop paying.
And this one single concept is a total game changer. Why? First, it gives the landlord certainty. You know that cash flow is going to be reliable. Second, that certainty directly pumps up the property's value. See? Investors will pay a premium for lower risk. And third, the banks. Oh, the banks love this stuff. They'll give you much, much better loan terms on a building with a rock-solid tenant, like Amazon. All right, so we know what it is and we know why it's so incredibly important, but how do investors actually figure this out? How do they peek behind the curtain and check the financial strength of a potential tenant? Well, it really depends on who you're dealing with. For a massive publicly traded company like Amazon, it's actually pretty straightforward. You just look up their credit ratings from agencies like S&P or Moody's. Easy enough. But for private companies, your local hardware store or that new restaurant, it's a much deeper dive. Investors are going to want to see tax returns, profit and loss statements, and they'll often demand that the owner personally guarantees the lease. Now, to make all this a little easier to digest, investors usually group tenants into three basic categories, or tiers. It's a really useful framework for quickly sizing up the risk involved. At the very top, you've got your Tier 1 tenants. These are the titans, the household names like Apple, Amazon, Walgreens. They're what's called investment grade, and they're about as safe a bet as you can get. Then you've got Tier 2. These are your strong regional or national chains. Still very solid, but they don't have that same global fortress of a balance sheet. And finally, you have Tier 3. These are your local mom-and-pop shops and startups. They might be the heart and soul of the community, but for a landlord, they definitely represent the highest risk. And as you can see, there's this really clear inverse relationship here. It's super simple. As you move down the ladder from a Tier 1 to a Tier 3 tenant, the credit quality drops and the investment risk just shoots right up. Landlords and investors are constantly trying to find the right balance on this spectrum. Now, this whole tier system isn't just some abstract theory for investors to talk about. Oh no, it has very, very real consequences when it's time to actually sign a lease. A tenant's credit quality basically determines who holds all the cards in that negotiation. So look at the difference here. A strong Tier 1 tenant, like a Walgreens, can walk in and demand lower rent. They might not pay a security deposit at all, and they can even get the landlord to throw in things like free rent or pay for renovations. But for a weaker Tier 3 tenant, the tables are completely turned. They're probably going to pay higher rent, fork over a huge security deposit, sometimes up to a year's worth of rent, and the owner will almost certainly have to personally guarantee that lease. Okay, so now that we've got the fundamentals down, let's dive into a couple of more advanced ideas that the pros really use to stay ahead of the curve. Here's the first thing the pros never ever forget. A tenant's credit quality is not set in stone. The rock-solid, can't-miss tenant of today might not be so great 5 or 10 years down the road. This idea is called credit migration, and it's the risk that a great tenant's financial health could take a nosedive over time. I mean, just think about a company like Sears. If you go back to 1990, they were the dream tenant for any mall in America, an absolute anchor.
Fast forward to 2020, and well, they were struggling, to put it mildly. And by 2018, bankrupt. Those leases became worthless, leaving landlords with massive, empty buildings. It's such a powerful reminder to always, always keep an eye on a tenant's financial health, not just on the day they sign the lease.
And the other thing pros do is look at the bigger picture. It's not just about one company. They're asking, how healthy is this company's entire industry? They're also checking exactly who is guaranteeing that lease. Is it just the local franchise or is it the global parent company? That's a huge difference. And finally, they think about how recession-proof a business is. When times get tough, a grocery store or a doctor's office is a way safer bet than a high-end luxury boutique. So let's bring this all the way back to our two buildings at the beginning. Building A, with Amazon, is definitely safer and more valuable today. But Building B, with its dozen local tenants, well, it's diversified. If one of those businesses fails, you've still got 9 others paying rent. So what's the smarter play? Do you go all in on the sure thing, or do you spread your bets? That right there is the multi-million-dollar question that every real estate investor has to answer.